Let's bring in Kristy Akullian to continue the conversation, senior iShares investment strategist at BlackRock. So, Kristy, welcome back to the show. Over the last couple of weeks, as the market's kind of broadened out, do you see interest in flows following to more speculative funds, or is the high quality trade still the way to go?
Yes, thanks for having me back, Oliver. I think that's such an important question right now, and the biggest one that we're getting from investors too is how does this market broaden out? Can it continue to do so, and is that going to be a persistent trade? I think that what we're seeing in terms of markets and where we still have a lot of conviction right now is that still up in quality. If I could step back a little bit, I'd say that we still continue to prefer large cap over small cap. We prefer growth over value right now. And then exactly what you have up on screen right here is high quality over speculative trades. I think a lot of that is tied to the macro narrative, and a lot of it's been backed up by the micro narrative that we've seen too, maybe today notwithstanding from the tech sector, but in some of the really strong earnings that we got, even from the Magnificent Seven and from the rest of the cohort of those really strong quality names as well.
It's a really good point, and indeed, today's selling obviously an exception to the rule. Generally, does it seem like earnings, to your point, supported that strength? And can we say that this is a fundamental earnings-driven rally at its core?
I think a lot of it did. Yeah, I really do think that many of those high quality companies, the Magnificent Seven became sort of the maligned seven at some point, where everybody, thought that they had maybe run a little bit too far. I think that what we really saw from earnings was that a lot of them backed that up. So we're seeing the result of a lot of the work that was put in last year, some of the cost cutting measures, and we saw a really supportive macro backdrop to really lay the groundwork for really positive earnings as well. So we're seeing good things. We're seeing positive earnings revisions, and we're seeing expanding margins. And most of that right now is still being led by those high quality pockets of the market. And that does look like large cap, and it does look like growth, and it does look like tech. So until we start to see that narrative change a little bit, both on the macro and the micro, we still feel pretty comfortable staying up in quality at this moment.
Okay. Some of the other sections of the market have tried to break out, haven't quite gotten there. The small caps really given it their all. Got to a 52-week high intraday for a moment yesterday and then came back down. Some of the value stuff also that's been beaten down. Rob Arnott last week told us it's now like the best opportunity to buy value that we'll probably see ever. Of course, you've heard it a few times before as well. When you look at some of the underloved stuff, how is the investment community treating it? Are there inflows but less? Are there outflows? What do you see?
So we haven't actually seen as many inflows as we would expect, given the amount of conversations that we're having relative to catch-up trades, right? I think that what we see in our data, and we've got some really interesting data sets, particularly into places like where financial advisors are putting money. And what we saw is that a lot of them allocated to value and small caps last year. Obviously, this Magnificent Seven and market concentration conversation has been going on since last summer. So we actually saw a lot of them allocate, in advance. So I think that has probably muted some of the flows that we otherwise would have seen to the start of this year. But I do think that just the broadening out that we saw in February, every sector of the S&P 500 was up in February, albeit not up as much as tech. I think that that's going to start to spur a little bit more interest in terms of where these catch-up trades are going to be found. I don't think that we see as much opportunity in small caps right now. I think there's a really narrow path for macro and for the broader economy to follow that can mean that small caps are really going to have a durable moment in the sun and not something that just looks a little bit squeezy to us. We're going to need to see, growth stay strong, if not accelerate. And we're going to just need to see a much clearer line of sight into when interest rate cuts are actually going to materialize. So until we get that, we're pretty cautious on small caps. Within value, I do think we see pockets of opportunity in certain sectors. We do like financials, as we think that we're going to get a bit of a steeper yield curve, which can do well for those companies as well.
One of the lovable laggards, as you put it. Are they the only ones in that category? What else we got in there?
Yeah, so I'd also throw healthcare in there. I think healthcare and financials have actually had a really good run. We put out our 2024 year ahead outlook at the end of December. We talked about those lovable laggards. They've done really well so far this year in terms of just performance. Healthcare was one where we did start to see a turnaround in terms of earnings that looked positive to us, so a little bit of an inflection higher. And then I think that was also just predicated on the fact that it was so unloved and so under-owned last year that we thought that could be a tailwind as well. So we do still think that there's room to run for some of those lovable laggards.
Okay. Now, is the macro conversation still centered around cuts? Kristy, does that get a lot of inflow into bond funds that maybe had been shunned the last couple of years? Or do people look at the cuts and just put it all into your Bitcoin ETF instead?
Certainly that has been attracting a lot of attention and flows. Not all of them, though. So, I think that the conversation around cuts has been really interesting. And even what's developed in the last couple weeks has sort of caught our eye. So even as interest rates moved higher in February, and the number of cuts that the market expects overall has definitely fallen by about half, from almost 7 cuts to between 3 or 4 this year. We've actually seen equity markets perform, pretty well and hold up. So equity markets are resilient because we think they're actually focused more on growth. On the fixed income side, to kind of back to your question there, I think that this reset higher in yields, it can provide an amazing opportunity, maybe the last chance for investors to really extend duration before the Fed starts to cut interest rates. So I know we've been talking about that for a little while. We see this most recent backup in yields as just another opportunity and maybe the last best opportunity for investors to step out of cash and to add that duration.
All right. Kristy, great conversation. Thanks a lot. Good stuff.
Thanks for having me.
Appreciate your time. Kristy Akullian, Senior iShares Investment Strategist at BlackRock. Right. A couple sectors there in the lovable laggards category, but until disproven, a high quality trade has been the place to park the cash.